Hi guys, welcome to Investing with JYK, and today we'll talk about a bond from Sears Holdings. Yes, Sears Holdings, the one that's going bankrupt. Well, I don't know when it's going bankrupt, but I'm pretty sure it will go bankrupt within 5 years, I would say. Um, so this one is a senior secured loan that matures in October 15th, 2018. You can see there are these crazy craters in price. The face value is $100 and it's maturing in 3 months and 3 days. And currently it's about 90 something. It says it's 85, but I think it's bullshit. It's probably like 93 at the moment, I think. Or maybe it's not. I don't know. In any case, your what if you get paid out, in the end you will get the $100 face value. You will pay $90. You get $100 face value. You would get the last interest payment, which is due on the day that the principal is due. Okay, so let's see if what exactly is this bond and whether Sears can pay this bond. And we already know the upside. The upside is basically about $10 out of $90. So you pay $90, you get $100 back in 3 months. If it works, it'll be fantastic. If it doesn't, we want to know how much one can lose. So I dug up the annual. I think this is either annual report or no, this is the quarterly report. But in any case, it has the information we need. This one is actually, this is talking about that. So this thing is called old senior secured notes, right? It's not actually new senior secured notes. It's old senior secured notes. They have very innovative names, very creative names, sorry. So, back in 2010, they sold $1 billion of this old senior secured notes for 6 and something percent, 6.625%, and due October 15th. So that's the exact same thing we're talking about. And they did something, and something happened to them, and that's not very interesting. But the interesting thing here is the old senior secured notes are guaranteed by certain subsidiaries of the company and are secured by a security interest in certain assets consisting primarily of domestic inventory and receivables, the collateral. Okay, so that means in a bankruptcy, you will be in line, you will have a secured claims, basically the sale of all those assets. If, well, anything of those assets, so basically the whatever inventory and receivables will be paid out to the claim holders, the old senior secured claim holders, in the case of a bankruptcy. And now one thing is, how much is inventory worth? Probably not a lot, because these inventory is what, clothing, right? Unless it's appliances or something, these retain pretty good value. Electronics, these have a fairly set value, but clothing, really, I mean, it can be $20, it can be $10 and $50. The cost of producing them are not that different. It's all like marketing and brands, and maybe not even brand, it's just the way that you display them will change the price that you can sell them at. So pay attention to that. And it also says that the lien that secures the old senior secured notes is junior in priority to the liens on such assets, on these assets, on such assets that secure obligations. Oh, no, sorry, no. This is the collateral, and then here's on other assets. On such assets that secure obligations under the amended domestic credit agreement, as well as certain other first priority lien obligations, and following the consummation of exchange offers obligations under indenture relating to new um, senior secured notes. Okay, so what are basically this tells us who's sitting above us in the capital structure. So you got this amended domestic credit agreement, which is somewhere up here, right? And then essentially they have a bunch. Basically, all these are secured loans. It doesn't really talk about what exactly is the collateral. In fact, we don't really care because you can't pledge the same piece of collateral to two different loans. So I don't really care. That means that, if in a bankruptcy, these guys will take probably all of their collateral. I won't have much claim to it. And then the other thing is, there was an exchange from this old senior secured notes to new senior secured notes, basically extending it by like a year or so. Let's see, where was the exchange? Here, there's an exchange offer that basically gives you something that is due in 2019, 1 year later. That is a convertible loan convertible note that is also yielding the same percentage, right? But the whole point of a convertible loan is that it can participate in the upside. But I really don't think Sears has much upside left. But the other thing is they get seniority over old senior secured notes with regard to their collateral. So let's see. Obligations under indenture rating. Okay, so what is the I'm trying to see what is the collateral for the new senior secured notes. The new senior are optional convertible by whatever. 5. So if the stock goes above 5, you can convert and just sell. That's a nice thing. But Sears, I'm not quite sure this thing's going to 5. It's probably more likely going to 0. Sears stock. Yeah, it's a $2 stock. I mean, a convertible loan, you can think about it. One like this, a convertible note is more like a bond plus an option. So the user will be paid semi-annually, whatever, matures in October, so basic 1 year later. Are granted by certain subsidiaries of the company and are secured by a security interest in the collateral. Oh, it's the same. It's probably the same collateral. Ah, shit. Oh well. Senior lien and such assets, secure obligations. Okay, so actually, they actually put multiple loans on the same collateral. Oh well. I think it indentures were issued restrictive covenants. Okay, so I think it's safe to say that, well, I didn't dig all this through, you can probably tell, but I think it's safe to say that in a case of bankruptcy, the old senior secured note holders probably isn't going to have much left in terms of the collateral value, because the collateral, they're ranking lower in the collateral compared to the two classes, right? The domestic credit agreement guys, and then the guys that did the exchange and then got the new senior secured notes. Okay. So the other thing that we want to know is how much of this old senior secured notes are left. And 134 million on May 5th. And I don't think anything would have changed because the exchange expired in March. So this probably won't have gone down. And this, it says, is included within the current portion of long-term debt in the condensed consolidated balance sheet. So, which is here. Actually, no, here. So, just to recap, you probably won't benefit too much from the collateral. Sears probably pledged all their shit to bond holders, any kind of note holder. And in a case of bankruptcy, the unsecured claimants probably will end up with very little in this case, if anything at all. Now let's see what is the probability, roughly, obviously there's no mathematical formula for me at least, that they will be able to pay out in October. So their current asset, things that supposedly is readily liquidatable, is 4 billion, and out of that 2.8 billion is inventory. So that's not extremely liquid. You can't sell this at a fast pace without losing a bunch of value, right? And then you have some receivables. That's probably not too difficult because what are they? Yeah, so it's nothing. I think these receivables will be collectible, and then you have prepaid expenses. You don't really care. You can't take these back. Cash, you got 186 million. I think it's $1 million of cash, and 280 million of restricted cash, whatever that means. I should check it out, but I'm sure, you know, if it's restricted, you probably can't do too much. And in terms of current liabilities, total is 4.9, and that is more than current assets. So that is a red flag. And you got short-term borrowings, that is what? A line of credit. So not sure when that is due. You got 433 million that's due, that have to be paid within a year. Out of that, around 130 is the senior secured loan. So, and then they have some payables. So that's the money they owe to their suppliers. And they have some unearned revenue, but that is basically, I'm guessing it's the cash actually already came in. They have to continue to provide some kind of service. It's either It could be a gift card. I'm not sure if they would account gift cards here. But unearned revenue, is it not going to cause a cash outflow in the future though? So, okay, so then the other thing that we want to look at is their cash flow statement. For May, for the Q1, they basically lost $1 billion in cash. Not good. But for some reason, they were able to raise $1 billion in debt. That is good. Why is that good? It just tells you that some sucker is still willing to lend them money. Well, the short term was 630 million, and then the actual bond issuance is 991. So part of that is the exchange from old to new, and then they have some sales to lease back financing, and then they pay something. Okay, so the question boils down to, do you think, given this kind of scenario, you get the cash flow and then their balance sheet, do you think they will be able to pay their $130 million in 3 months? I think the probability is very high. That's just me. And the market at the moment still agrees. It's paying $90 on 90 cents on the dollar. But if something happens, I don't know what happened here. If you look at 1 year, something happened at the March, and the price was crazy low. It was like 70. So if you bought there, you made a shit ton of money. But even if you buy now, and if the thing works out, the annualized return might be like 40–50%. I bought some myself for disclosure, but yeah, it's for this bond. I think that the more interesting thing is, try to think about this cash flow and try to also predict how open the capital market will be for 3 months, and let's see how this turns out. I don't know. I mean, I don't know if I'm going to make money or lose money on this, but it's a very interesting experience. It's distress bond is very interesting. I recently read this book, Distress Investing, and they talk about what happens when a company goes into bankrupt, what happens to different claim holders, and basically all the professionals, so the lawyers and accountants, will get paid first in cash always. So they are always the winners, and well, equity holders always fucked. So that's just a given. And then the preferred is always dead, always that too. And the unsecured senior, in the past experience that there was a case study about like Kmart. Kmart went through that in like 2002 or 6, sometime around that. They eventually got bought by Sears. But during that bankruptcy, their unsecured senior took a haircut about 60%. So they returned about 40% of the face value. But that's unsecured senior. So at least this one still has some collateral in it, even though it's ranking junior to a bunch of people. So we'll see how this turns out. And yeah, just a interesting, I think interesting security. It's a very different security than just stocks, and I personally find this somewhat stimulating. And yeah, so that's it for me today, and see you next time.